Welcome to this week's live ASX strategy session. Thanks for joining me for another show. Heaps going on in the markets this week with a big rebound in stocks, some movement in the commodity markets, and also any stocks you'd like me to have a look at. Get those ticker codes ready. We'll go through those in the second half of the show. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get straight into this week's first chart, starting with the ASX 200. Well, we've now got this V-shaped recovery. What does that mean, and should you be buying? I'll talk more about this in a minute. And then over in the US, the S&P 500, well, it's had 7 up days in a row. Is this a turning point or is it a trap? Well, I'm going to go through that shortly. But before we do that, let's start with this latest price action in the ASX 200. So the standout pattern here is this classic V-shaped structure that we often see in markets after sharp sell-offs. And the ASX 200, well, it had a 10% decline from its highs, 10% down to the lows. That took about 14 days. And then on the way back up, it's been an 8.5% rally in about 10 days. So these patterns are often event-driven. We often see the V-shape after some sort of a notable event. And of course, we know what that event has been this time around. There's panic to sell on the way down, and then there's a rush to get back in when the situation goes from bad to less bad. It's interesting to start. It's interesting that we started to see the local market become resistant to selling about a week ago. And this is something we discussed in last week's strategy session when we spoke about the ASX 200 decoupling from the US markets. And you can see it here. So the ASX 200 made its low on the 23rd of March, but the low on the S&P 500, it was actually a week later. It was on the 30th of March. And that included 3 days of heavy selling into the 30th of March. So look what the ASX 200 did during that time. The local market didn't come close to retesting its lows from a week earlier. So it's not often that we see the ASX 200 decouple from the US. So that was a tentative positive. And now we have a rally back above the moving averages. So I think there are two key points to make here, 2 key points to take from this. Firstly, the rally back above the moving averages. So this rally back above the moving averages, it disengages the downward momentum and it removes the vulnerability that was present when prices were trading below the moving averages. People are often worried about crashes when during these period, and even now, there's still people worried about this crash, which they think is a high probability of happening. But it's when prices are below the moving averages, when prices are below declining moving averages, that the risk of a crash is greatest. We no longer have that condition now. Prices are back above the averages. It's not to say that prices can't come back down and things can't deteriorate, but at this point, prices are back above the averages. The bad stuff tends to happen below the moving averages, not above them. The other thing to note is the strength of the rally. Like, look how strong this rally has been in the last week and a half. It's been a powerful move, and powerful moves indicate aggressive buying. So that's how many bullish phases start. They start with that aggressive buying. It's when we get a shallow rally and prices struggle to move higher. Like, it's when we're below moving averages and prices really just can't lift themselves off the floor. That's when I'm most concerned, because that's a sign that the rally is being sold, and that's clearly not the case here with this strong rally. So I think that's a positive. So that's ASX 200. Let's look at some of the key sectors within the ASX 200, and starting with the materials. So this is where we find all the big mining stocks. And like the ASX 200, this moved back above the moving averages. It disengages that downward momentum that was in place over recent weeks. And I think that the strength of this snapback rally suggests to me that the sell-off was panic-driven. It wasn't part of a larger, longer-lasting trend change. As I said last week, I thought the strongest part of this rebound may have been getting to an end last week when prices got back towards the moving averages. But as it turns out, prices have continued higher this week. That said, I still think it's unlikely that this continues just to power straight back up to the March high, or which also happens to be the all-time high. I think a more likely scenario is that prices settle into a big trading range between the March high and the recent low. What a lot of people forget is that markets just don't go up or down. There's also plenty of time when markets just move within ranges. And I think that could be what happens here. I think there's a strong possibility that the materials settle into a big range for several months. And look, don't forget, like from the lows back in April last year, that's an 83% rally in just 11 months. So that's huge. I think it's going to take time for that rally to consolidate. That's why I don't think we go charging back to new highs and beyond in the near term. But the positive here is that as it stands, this overall upward move, I think this overall upward trend in materials remains in place, and that should be supportive for the ASX 200. And if we look at the financials next, so the ASX 200's financials index, what's interesting here is that financials never actually broke down. Like, we just step back and look at this chart, there's not a breakdown in the financials, and we've discussed this in recent weeks. They've essentially been in a big range since late October. So there's the October high, and there's a big range. Yeah, popped above it a little bit in February, but nonetheless, we're oscillating either side of these moving averages since October. Not a breakdown, but a trading range. So there are also a series of rising lows. So looking from December, we've got a series of rising lows in place there. We've got a strong rally this week. So the underlying structure of the financials index remains supportive. Coming back to the ASX 200 just for a moment, when we bring all this together, what we've just said in the ASX 200, what we've seen in materials and financials, when we bring it all together, I think we've got a volatile pullback in the ASX 200, not the start of a longer lasting bearish phase. The next test for the ASX 200 is whether it can re-establish itself above the moving averages. If it can do that, then it starts to build a platform for higher levels in the coming months. So we got sideways consolidation above the average. That could set that platform in place for higher levels. I think this is a time for cautious optimism. I know there are lots of reasons to remain fearful, but the price action is suggesting otherwise. This strong price action is suggesting otherwise. And this is where that good trading plan becomes so important. So for me, it's about following the price action and acting systematically rather than following the news and reacting emotionally. Wide trailing stops. That's what help us see off this sort of period as best as possible, and then looking for the re-entry signals as the new setups start to come into place when that happens to occur. Okay, so we're going to do the US market in a sec. But first of all, if you're getting some value from this, please click that like button. It helps me heaps when you do that, because YouTube shows other people. And when people watch, YouTube then snowballs and shows more and more, and that helps me heaps. So please do that. Click that like button. Leave a short comment. What do you think? Is this a start of a recovery, or should we still be bracing for a crash? What do you think is going to happen next? Okay, so S&P 500. Let's go over to that next. So some big changes in this chart during the last few days. Last week, we spoke about the downward momentum being disengaged by this strong two-day rally off the low. But that was just 2 days. That was just a 2-day rally, and the S&P 500 was still in a vulnerable position below these declining moving averages. So as always, it's a 50 and 100-day moving averages. Now this is, but what we have now, we've got this strong move above the averages. Now this next bit is interesting. Many people would say that Wednesday's gap higher, as you can see where prices, there they were on Tuesday, then they gapped higher on Wednesday. Many people would say that that was the next sign of the turnaround. We had the 2-day rally and then nothing much happened until we got the gap higher. But what's interesting is the 3 days prior to the rally, prior to the gap higher. Let me just expand this section of the chart. It's all in hindsight now, but it helps you understanding to see how these things can unfold and where the clues have been. Now, prices started to become resistant to selling 3 days prior to the gap higher. So just look at this bar starting on Thursday last week, and then going into Monday and then Tuesday. You'll note how prices started becoming resistant to the selling, and that is because prices would either open lower, test lower, and then rally, or open near their highs, sell off, but then come back towards the end of the day. So all of these closes, these 3 closes, were all up near the day's high. So this is very different to what we'd seen in previous weeks. You can see just prior to that, the rallies were failing and prices were closing near their lows of the day. That happened on several occasions. So the signs were there prior to the ceasefire announcement that a shift in positioning was happening, and that's what you get through these closings on the high. And now we have a gap higher that takes prices above the moving averages. So another notable feature of this rally is that the S&P 500 has had 7 up days in a row. So you go back down here to the 31st of March. You can count them through. There's seven up days in a row, and that's a rare event. The last time we saw that sort of winning streak, it was April last year. So it was in this section, just heading into the end of April. It's this section through here. There were 7 up days in a row, and then prior to that, you got to go back quite a bit further to find the next one. And what it indicates when you get this ongoing winning streak, it shows persistent buying, and persistent buying is a good indication of underlying strength. Like whether it works out like it did last year, well, that's yet to be seen. No one knows how that's going to play out. But 7 up days in a row, there is underlying strength coming into the market. I think this is more than a short covering rally. So last week the concern was, yes, it's a good bounce, but it's 2 days. Is it just short covering? It's now built on this. The rally is now built on that. So I think this is more than a short covering rally. I think it's a repositioning back into stocks. The key now is for the S&P 500 to hold on to these gains, or hold on to a good portion of these gains. And for that to happen, if this is actually a recovery of substance, I don't think prices should come back and fill in this gap. You can see the gap between the open and the open the next day. Prices shouldn't come back and fill in this gap. Like, we shouldn't get a structure where prices come back. Let me get this marker working. Shouldn't get this sort of structure where prices come in and fill the gap if this is a rally or a recovery of substance. There's a misconception, I think, with a lot of people that gaps always get filled, and people send me emails at times and say, "Oh, look, there's a gap. Shouldn't that gap be filled before prices can rally?" And that's not right. Look at these gaps from last year. So look, there's a gap there in around the 22nd of April, and then here's another gap which was never filled around the 12th of May. So these gaps often don't get filled. And then there's we go back even further. I can just show you look at this one here. Here's another good one. There's a gap there. Like after a big sell-off, when the repositioning back into stock starts, there's a gap higher, was never filled. And just to continue that point one more time, come over to COVID. Look at the COVID recovery, gap higher, and then we've got another gap higher. Here's another gap higher back in May. These gaps were never filled. If you're sitting there saying, "No, I'm not buying until the gap's filled," well, you're kind of still waiting. So sometimes they do get filled, but they don't always. It's not a rule that gap must be filled. So it's I think gaps higher after a decline, after a big decline, after a volatile decline. I think these gaps higher are a positive sign. They indicate strong buying, and they often lead to additional gains. I say often, not always, nothing's always, but they often lead to additional gains. Now, this doesn't mean prices are going to go straight back to all-time highs, but I think it shifts the odds away from the worst-case scenarios, and it keeps the overall bullish trend in play. I think we can say that, from these lows back in 2022, the overall trend is still upwards. We don't have bear market conditions, and we haven't had bear market conditions throughout that time, notwithstanding significant volatility during periods. As I said, the key now is to hold on to these gains. That would involve prices becoming established above the moving averages, and I'd also expect the upper portion of this gap to provide support. So this is where buying of the dip should happen if it's going to happen. Now, just over to the Nasdaq to update on what's been going on here. And it's also been strong price action. That supports what we're seeing in the S&P 500. There are also several things happening here. So firstly, prices are back above the moving averages. So again, it removes that vulnerability that happens when prices are below declining moving averages. And the rally has also broken a sequence of lower lows and lower highs that had been in place over the last couple of months. And so the risk of a crash type scenario has diminished significantly with that sequence of lower lows being now broken with this move upwards. The other interesting feature is the reversal of a breakdown from 6 weeks ago. Oh no, from probably about 3 weeks ago. It was a 6-week trading range. You can see this 6 weeks trading range. Prices broke down, extended for about a week and a half, and now we've got this reversal of that breakdown. I wouldn't call this a false break, as it did deliver a sizable fall, but it hasn't triggered an ongoing decline that could have developed into a bear market. One possibility is that this low, the March low, completes a correction from the October all-time high. So just follow this through. You'll recognise. Let me just map it out for you. From the October all-time high, is that classic zigzag structure that we often see in markets: the initial decline, the rebound that doesn't regain the momentum, and then the final flush out low. It's certainly a possibility. It's got that distinctive zigzag characteristics to it. And it's interesting that the final part of the decline came with all the fear, all the dire predictions that are typical of the latter stages of that zigzag sell-off. Of course, nothing here is certain. These are early positive signs, and these positive signs, yes, they could fade, and yes, selling could return. But I think there's enough here at the moment to start considering upside possibilities. I think a mistake a lot of people make is they focus on the catalyst for the sell-off for too long, and they do that in anticipation that things are going to get worse. Sometimes they do, but often they don't. So I think we can manage risk with exit strategy. So it's not about going all in here, saying, okay, we're back above moving average. It's not about going all in. Rather, I think it's a case of considering good setups and having a plan to protect capital should they not work out. We've got to be mindful of risk still. But I think the pendulum starts to swing back to reconsidering good setups that could lead to ongoing gains. Okay, so I'm going to jump over to the small caps next. Small caps also very interesting to look at. We're going to go through the commodities, going to go through your stock codes, but of course that wraps up the free section. If you're not a strategy session member, click the link below, come in. There's a whole lot more to go through, a whole lot more interesting information that hopefully will be able to help you. And also like having your stock codes, getting me to have a look at those. So think about doing that. It doesn't cost you very much. Cost of a cup of coffee, really. So think about doing that. Come on in, and a lot more to do. All right. So having said that, let's jump over to the Russell 2000 next, so the US small caps.